Here's the shocking truth: your state pension could trigger a tax bill even if it's your only income. Starting in 2027, thousands of retirees who rely solely on their state pension could face unexpected tax demands from HMRC, with bills reaching £117 or more. But here's where it gets controversial. Is this a necessary fiscal adjustment, or are frozen tax thresholds quietly becoming one of the biggest stealth taxes on Britain's pensioners? The tax trap nobody saw coming. Many retirees don't realize that state pension income has always been subject to income tax, though this fact rarely mattered in practice. Until now, pensioners receiving the full state pension, whether under the new or basic system, stayed comfortably below the £12,570 personal allowance threshold, meaning they owed nothing to the taxman. Those with no additional income sources have historically remained tax-free, except in rare cases like the pre-1997 pension scheme. That comfortable cushion is about to disappear. Following Chancellor Rachel Reeves' autumn budget announcements, two critical policy decisions have collided: the continuation of the triple lock pension increase and the extension of frozen income tax thresholds through the financial year 2030-31. Together, these measures create a perfect storm for pensioners' wallets. When math becomes a problem for pensioners. Let's break down exactly what's happening with some numbers. By 2026, the triple lock mechanism will push annual state pension payments to £12,548, sitting just £22 below the personal allowance threshold. That's incredibly close, but still technically tax-free. The real pinch arrives in 2027. At that point, the triple lock guarantee, which increases pensions by at least 2.5% annually, though likely more based on earnings or inflation, will inevitably push state pension income over the threshold. Using the minimum 2.5% increase as a baseline, pensioners would receive an additional £608.58, bringing their total yearly income to £13,156. Of that amount, £586 exceeds the frozen threshold, resulting in a £117.20 tax bill at the basic 20% rate. And this is the part most people miss: because tax thresholds remain frozen until 2031, this problem compounds each year. Unless the government introduces a specific exemption for pensioners before April 2027, this tax liability becomes unavoidable for anyone relying solely on their state pension. A silver lining, with very few details. There is one piece of potentially good news buried in the Chancellor's announcement. Ms. Reeves confirmed that pensioners won't need to navigate the bureaucratic maze of completing simple assessments to pay these smaller tax bills to HMRC. However, the government has been frustratingly vague about alternative payment methods, promising more details later but leaving pensioners in limbo about the practical implications. Mike Ambery, who serves as Retirement Savings Director at Standard Life, part of Phoenix Group, offered his perspective on the broader implications. The government's decision to extend the freeze on income tax thresholds until 2031 represents one of the most significant stealth tax rises in recent years. He noted that what began as a temporary measure has evolved into something far more impactful, especially when combined with wage growth and inflation steadily pushing more people into higher tax brackets. Regarding pensioners specifically, Ambery explained that April's increase will bring the full new state pension to £12,547.60 annually, tantalizingly close to the frozen personal allowance of £12,570. From 2027 to 28 onward, the state pension is projected to exceed this allowance, meaning numerous retirees could technically face income tax obligations on their state pension alone. The government's commitment to eliminate simple assessments for pensioners whose only income comes from the basic or new state pension, without increments, should ease administrative headaches for this particular group, though implementation details remain forthcoming. The bigger picture: why this matters beyond £117. While the elimination of simple assessments may provide relief for some, the reality is that pensioners with even modest supplementary income, whether from private savings accounts or workplace pension schemes, will continue facing tax liabilities. The personal allowance freeze affects pensioners just as it does working-age taxpayers, pulling more people into the tax net regardless of whether their actual purchasing power has increased. Ambery highlights a crucial consideration that often gets overlooked: the state pension remains below Pensions UK's minimum retirement living standard by around £1,000 a year, so additional saving is still essential. This creates a concerning scenario where frozen thresholds could potentially discourage private pension saving, since any supplementary income immediately becomes taxable. Despite these challenges, pensions remain one of the most tax-efficient savings vehicles available. Contributions attract tax relief at your marginal rate, meaning individuals moving into higher tax bands could actually benefit from greater relief percentages. With thresholds locked down until 2031, reviewing your pension strategy and maximizing available allowances has never been more critical. Ultimately, while this policy helps the government meet its fiscal targets, it places greater responsibility on individuals to actively manage their long-term finances. Taking stock of your pension pots and investment choices now can make a substantial difference in protecting your future income from erosion. So here's the question nobody in Westminster wants to answer. Should pensioners, many living on fixed incomes barely above minimum living standards, really be the ones bearing the burden of frozen tax thresholds? Is this fair fiscal policy, or does it cross the line into exploiting the most vulnerable? Drop your thoughts in the comments. Do you think the government should create a specific pension tax exemption, or is it time pensioners contributed their fair share like everyone else?